Forget price predictions for a moment. No $5 XRP, no $10 XRP, no hopium targets on a thumbnail. In this video, we're going to talk about something more important than a number on a chart, the rails underneath that number, and what happens if Ripple's hidden payment engine actually turns on at scale. So let's start with a simple picture. It's 2026. A small business owner in New York opens a payment app on Monday morning, taps Pay Supplier, and sends $50,000 to Europe. The money shows up in minutes. It's a dollar balance, fully accounted for, ready to use. No one talked about Swift codes. No one worried about cutoff times or bank holidays. The payment just moved. Now here's the part almost nobody sees. On the screen, it looked like a boring dollar stablecoin. Under the hood, the settlement ran on XRP. The front end spoke the language regulators and accountants are comfortable with. The back end spoke the language of speed and liquidity. That front-end, back-end split is the core of Ripple's plan. For the next few minutes, I want you to ignore noise and focus on three building blocks. First, a compliant dollar-backed stablecoin, RLUSD. Second, an institutional custody and tokenization stack, Metaco. Third, XRP as a neutral bridge asset in the middle. If those three line up, price becomes a side effect of something much bigger. Real value moving across real rails. Start with the dual liquidity model. On the surface, treasurers, fintech apps, and payment companies want something that feels like cash. They need predictable accounting, clear audits, and a unit that doesn't shock the risk committee. That's RLUSD's job. It's the front-of-house money, the number you see on your statement, the asset you invoice and report in. Behind the curtain, the network has a different job. It needs to move value between currencies, platforms, and jurisdictions as fast and cheaply as possible. It needs deep liquidity in many corridors. It needs something neutral, programmable, and always on. That's where XRP fits. RLUSD handles human comfort. XRP handles machine efficiency. Imagine you're that New York business again. You send RLUSD from your balance. The system debits RLUSD. In the background, a routing engine looks at different paths, checks spreads, taps XRP pools to bridge value into the destination currency. Maybe it goes RLUSD to XRP to Euro. Maybe RLUSD to XRP to another stablecoin. You never see it? You just see the payment land. Now widen the lens. Tokenization is where this gets much more interesting. Around the world, money market funds, treasury bills, corporate credit, and even trade receivables are being wrapped as tokens so they can move and settle more like software than paperwork. For that to matter, institutions need two things: custody they can trust and fast, predictable netting. Metaco is Ripple's answer to the first. It's infrastructure that lets banks, asset managers, and custodians hold tokenized assets with the same seriousness they hold traditional ones. You can't move trillions on-chain if the people who move trillions don't trust the plumbing. Pair that with a bridge asset like XRP, and suddenly those tokenized positions can be rebalanced, redeemed, or pledged in seconds instead of days. A fund can roll exposures. A bank can move collateral. A corporate can free up trapped liquidity. And in front of all of that, RLUSD stays the clean, reportable unit that shows up on the balance sheet. Let's make it concrete with two quick flows. First, a cross-border SME payment. A company in Germany owes money to a supplier in Turkey. The payer funds their account in RLUSD and clicks to pay. RLUSD is debited. A routing engine converts into XRP, sends across the appropriate corridor, and converts into local currency or RLUSD on the other side, depending on how the receiving side is configured. The supplier gets their money the same day, maybe in minutes, even on a weekend. Second, a tokenized money market redemption on a Saturday night. In the legacy world, that request sits in a queue until markets open. In a tokenized world, the investor's units exist as on-chain positions held through Metaco-grade custody. They trigger a redemption. The system calculates the amount, uses XRP to handle any FX or cross-venue hop, and delivers RLUSD back to the investor's wallet almost instantly. Boring for the user, but a big deal for liquidity and risk. Where do central bank digital currencies fit? Not as enemies, but as neighbors. CBDCs, bank tokenized deposits, and private stablecoins will all need to interoperate. That's where shared standards matter: ISO messaging, digital identity layers, compliance APIs. In that world, a CBDC in one country, RLUSD and XRP can all talk across the same messaging fabric. The user presses send. The infrastructure quietly chooses the mix of rails that gets the job done with the least friction. This is where XRPL's design choices start to look very intentional. Its built-in AMM tightens spreads on key pairs and keeps corridor liquidity healthy, instead of chasing total value locked rankings. Hooks let tiny pieces of logic run directly on payments, compliance checks, alerts, limits, automation. The EVM sidechain opens the door for Ethereum native developers to plug in wallets, middleware, and DeFi-style services while still settling activity back into an XRP-centered payment world. Of course, none of this is automatic. There are real risks. US policy on stablecoins, custody, and tokenized assets could speed this vision up or slow it down. Stablecoin incumbents like USDC and USDT already own a huge share of distribution. RLUSD has to earn its way into real payment flows. EVM ecosystems still have most of the developer mindshare. The XRPL EVM sidechain has to feel smooth and cheap enough that builders actually want to use it. And macro conditions, liquidity, rates, risk appetite, will always decide how fast institutions move. So how do you, sitting at home, tell the difference between a nice slide deck and a stack that's actually coming to life? You stop staring at intraday candles and start watching adoption signals. Look at whether Ripple-powered payment corridors are adding countries, partners, and volume. Watch whether RLUSD, once live, is actually issued, listed, and integrated into real platforms or just name-dropped in announcements. Track whether AMM liquidity on XRPL deepens over time on pairs that matter, like RLUSD against XRP or fiat-linked assets. Pay attention to whether CBDC and tokenization pilots move from white papers to limited production to real usage with XRPL or Metaco visibly in the flow. And keep an eye on regulatory milestones in the US, Europe, and Singapore that make this stack easier or harder to deploy, plus developer momentum on hooks, the EVM sidechain, and third-party wallets. The more of those boxes you can quietly check yes on, the less you have to guess. You're not praying for a number anymore. You're tracking an adoption curve in real time. That is the mental shift this whole video is about. XRP is not just a ticker. RLUSD would not just be another stablecoin. Metaco is not just a press release. Together they form a very specific thesis: front-end compliance and comfort, back-end speed and neutrality, institutional-grade custody, and tokenization. Whether that thesis wins is an open question. But at least it's a question you can measure instead of a dream you can only hope for. This is not financial advice. It's a framework you can reuse every week. Instead of refreshing price, refresh the signals. Instead of asking when moon, ask, are the rails actually being laid? If you got value from this, hit like, subscribe, and drop the word radar in the comments. I'll share a one-page checklist you can use to track these indicators yourself. Headlines will always chase attention. Rails quietly move the money. And if Ripple's hidden engine really does come online, you'll want to be watching the rails, not the noise.